All right. So welcome everybody to my first Finimize community conversation. It's an honor to welcome you. I'm the Finimize host from Berlin, today actually from Barcelona. And we have a very interesting topic, how to craft your trading strategy. So I think this is a topic that we have seen a major increase of people trading. I think because of pandemic, because of like people having a lot more time, more money, not spending the money, so they have more money for trading and they don't want to like get eaten by inflation. So a lot of jumping on the trading, but I think sometimes you need to do it right. So that's why I had the honor actually to welcome also Henry Ward, that has more than 10 years of trading experience, one of the builders of the trading school, one of the world's largest social investment platform. And I met him actually, been learning a lot from Henry. So I appreciate Henry the time to being with us and sharing your experience. I probably will. I will have just want to make sure for you guys, just housekeeping. Please introduce yourself on the chat. I think it's great to hear from everywhere where you're from and what are you up to. And if you have any questions, just post it in the Q&A, and then you can upvote what is the best question. I want to have 15 minutes from Henry's point of views on the topic, how to craft your own strategy, and then we're going to go back 15 minutes on the Q&A. All right. So as regard the first question, Henry, I'll just leave the floor to you. So I'll also be posting some polls as well. If you want to share your feedback, please, and then you'll see the result. Don't get distracted. I just for us to learn more about you and how we can improve, since, as I mentioned, it's my first meeting with you. So thanks so much. Henry, the stage is yours. How to craft your own trading strategy.
Well, thank you very much. I hope I can live up to that sort of billing. I've been trading sort of for 10 years. So in the trading industry, it's very niche and quite small, as well as being so huge. So I traded with a company called Learn to Trade. Then I went into the likes of eToro and built the education for the whole education platform for eToro for the last 2 years. So that's where we met, Mario. So it's one of those things that's been going on. And like you said, the pandemic has kicked off. And then when people sitting at home, you have people on furlough and not working, and all of a sudden trading has come to the forefront of everyone's imagination. So everyone wants to get in and actually start trading. But the question is where do you start? Now, this leads me lovely into the first question. And now the first question is, how do you craft your own strategy? Now, before we even get that far, we have to work out what type of trader you are. If you are a trader or whether you're an investor. Okay, so the difference between the two of those is an investor is someone who will hold on to a trade long term. Now, when I say long term, I mean 6 months, a year, up to 10, 20, 30 years. So that's an investor. And the second one then is a trader. So a trader is someone who can jump into the market, and they could be in the market as little as 15 to 20 minutes, or they can be in the market for up to 2 or 3 months. And that's a trader. And you have to work out which type of trader you are. Now, I was going to pull up some charts and show you guys and stuff like that there, but obviously we don't have enough time. So just to give you an example, so one of the markets out there is called the S&P. So it's the top 500 stocks in the US clubbed together and traded as one. Now, if you look at the S&P over the last 40 years, it's continually gone in an upward trend. So which means then if you bought it at, just say your mom bought it the day you were born, you would be up more money now than you are when the day you entered into it. Okay, it's simple as that. Doesn't matter what time you bought it, it's gone up every year, year and year, over on average about 10% a year. So that is an investor. So you buy it, you hold on to it, it grows about 10% a year, and then you let it run. That's it, plain and simple, and that's an investor. And that is probably the simplest and easiest way to trade. Now, the problem with that is you need a large amount of money to actually make this sustainable. Now, what some people do is every month out of their wages, they put some money away each week, and let it grow into the index fund, or whether it's the S&P. So the S&P is an index, so it works on a CFD basis. So you can't physically buy this, but there is something called an ETF. So it's an electronic transfer. Okay, so
CFD, Henry, sorry, what is that?
I'm going to come back to that in 1 second. So an ETF is electronic transfer, which means then you can jump in an ETF. Now the ETF of the S&P is called the SPY. Okay, so what it means is that people have just tracked the S&P and they've bought the 500 stocks. So a company has come out there. So the SPY has bought every stock that is in the S&P 500, and it means then that if you buy the SPY, you actually own part of all 500 companies. So that means if the S&P grows 10%, your stock portfolio on the SPY will grow 10%, and that's an investor, and that's how you invest. Now, a derivative or a CFD or spread betting, that's where the S&P comes in, because we cannot physically buy it, because it's not actually a thing that we can actually hold on to. So it's a derivative, so it's a contract. So when we're trading a CFD, we're not actually buying the underlying asset, we're taking a bet, or we're taking a punt. We're speculating that it's going to continue going up. And this is the beauty of day trading or short-term trading, is that every time we get a pullback on it where it gets cheaper, we buy it, and then if it goes up, we make money. Comes back down, we buy it again, goes up, we make money. But the problem with CFDs is we have to trade them with leverage, and people generally don't understand what leverage is. So that is sometimes why people are so scared of CFDs. But if you followed my education, you followed my thing like that, risk management is key. So when you're trading, you should only ever risk 1% of your capital per trade. So that's why CFD trading is so important, to make sure you risk manage. So that's that. So there's the two ways of trading. So I give an example of the SPY, which is the underlying asset, which is an ETF. And then you have the S&P 500, which you would have to buy it as a derivative, as a CFD or a spread betting. Okay, so that's it. So the next question that we have is that how to interpret market trends. Okay, so a market trend is very easy to sort of understand. So all we do is we pull up the charts. Now I'm a technical trader, so I really don't care what's going on fundamentally. I could not care less whether you're a $1 trillion company. I could not care less whether you've had the last 4 quarters are profitable. I could not care less of your intrinsic value. Okay. As a technical trader, all I want to see on the screen is the chart going from the bottom left up to the top right. And that means the overall momentum is going up. That means that we have an upward trend. Now this is going up. And if we have that upward trend, all I'm looking for is a pullback into an area. So that means that the trend is going up. And that means then this is a value, or this is growth. So I'm a growth trader. So I'm looking for growth all the time. I'm looking to jump in on a stock and let it grow. Now, it really makes no difference whether we're talking about stocks, FX, crypto, we're looking for growth. Now, when we're talking about stocks and FX, we expect the growth to go very, very quickly. Grow our stocks and crypto, we expect it to go very, very quickly. Same with commodities. Commodities have taken off because of electric vehicles. The commodity market has taken off massively over the last 6 months to a year. Copper, gold, silver, nickel, palladium, platinum, they've all taken off massively over the last 6 months to a year. And then you have the likes of the foreign exchange market. Now, the foreign exchange market is usually a sideways market. So this is a sideways market where it is bouncing between these two levels. Now, why the foreign exchange market is sideways is generally, we all know what happens after the pandemic. We had the quantitative easing happen in the market, where the US government literally printed $2.1 billion or $1 trillion and actually put it into the market. So that is a huge amount of money that they have pumped into the market. And that's what happens. The market has gone up. But unfortunately, with the foreign exchange market, there's 5 trillion a day traded in this market. So which means then that we have to we have to make sure that we're getting in at the right time. So a sideways market is like this, and that's a 4x, and it bounces between those levels over and over again. So the idea is when it hits the top ceiling, you look to short the market, and when it hits the floor, you look to buy it. And that's the idea. And again, because the foreign exchange market, you're trading two currencies. So for instance, you're trading euro versus US dollar. It is a CFD or a derivative. You can't buy the underlying asset on most brokers. And then the last question we have is, what two indicators do you use and how do you use them? Now, I'm someone who doesn't massively use indicators. I look at what's the trend, what's going on. But the one thing that I use is support and resistance. So for me, it is I like to keep the chart clean. I like to keep the chart with very minimal, so I'm not distracted by stuff. Now, I see people, I have a chat room there with 500 traders, and if you want to go to henryward.co.uk, you can actually jump on the chat room, and I see people all the time talking about indicators. We're talking about volume, talking about Fibonacci, talking about RSI, MACD, stochastic, Ichimoku. There's loads of them. There's literally the strategy out there. When the sun and the moon line up, that's when you buy. And you're laughing at it, but that, I swear to God, there's one out there that has that you know what I mean? So that's the problem. Our indicators are they give you a story, but it doesn't give you the full story. So the idea is trend, momentum, what's going on in the market. And then once the market is going up, we need to have a pullback. And this is where horizontal support and resistance comes in. Whereas if it hit the ceiling here, it's come down. It now breaks through that ceiling and it comes back down to this level. So it hit its head here, it's broken through, and it's now a floor. So it was a ceiling, it's now a floor. That is the logical place for us to place a trade again. That's a logical place as we're going up for it to jump back in. So support and resistance is absolutely key when you're trading, whether it's a trend line support and resistance or whether it's a horizontal level. That is absolutely key when you're trading. And I don't go into massive other stuff. Now, if I'm looking for a reversal, I will look for divergence on, say, the RSI, but other than that, my chart is very, very clean. I don't look into that. And then the second thing I look at when I'm talking about stocks, I look at the earnings reports. Okay, so every quarter, so a lot of stock traders forget about this, but every quarter there is an earnings report that comes out, and it is something that we can look at. So when we're looking at, say, earnings reports, so we'll take Apple, because I'm assuming everyone has heard of Apple. If you haven't heard of Apple, you've been living in a cave for the last 20 years. So the idea is that we can every quarter, so it happens on about the 15th after the quarter. So we're getting very, very close to earnings season. Technology generally have their earnings about the 15th. So we're on the 8th of the 7th. So the earnings season finishes or starts at the end of June or the start of July. So then we have that rollover. And that's what we look to do, is look at the earnings and find out what's going on with us. And we go to Yahoo Finance, we put it into Google, we can put up what's Apple's expected earnings. Now, once we're reading through this, we can work out what happens with the earnings this quarter last year. So that's something you have to look at. The earnings at this quarter last year, what it was, how did it compare to the previous earnings on that year? We look at what's the trend of the earnings of the last couple of quarters, and then also we look at the consensus. Now, just understand what the consensus is. So there are analysts out there that will actually come out and do a report on, say, Apple, for instance, or any company, and they will come together and give a consensus. So to give an example, so just say Tesla, because it's the easiest one to talk about. Now, if I'm an analyst and I'm implied to give my PE ratio or earnings per share or whatever it is on, say, Tesla. Now, I will sit outside one of Tesla's plants, and as the lorries go out, I will count how many cars is on the lorry, and I will work out how many lorries then leave a day. And then I can work out what sort of production they're coming out, what's coming out. And I know it's all sort of a little bit, iffy, airy, fairy, and that's the problem with analysis or analysts. Now, the idea would be is the likes of Apple would say have 10 analysts who have done it, and they'd be all independent, so there'd be nothing to do with the likes of Apple. And then what would happen is when the likes of the Wall Street gets all 10 of them, they would divide that by 10 and come out with an average. And that's what the consensus is. So a consensus is an average of what the analysts, overall independent analysts, have expected. Now, we have that. We have the trend, we have looked at what's happening in the previous quarter, and then you're making an educated guess, okay, if that makes sense. So you're making an educated guess whether it's going to be good news in this quarter, whether it's going to be bad news in this quarter, and that's what we do when we're trading. We're always taking an educated guess, and we want probability weighted in our favor, and that's all we're looking to do. So support and resistance, and then earnings, quarterly earnings, and they're the two things that I will use massively when I'm trading the likes of stocks. With FX, crypto, stuff like that there, I will use support and resistance, and then I will try find out what fundamental news. If I'm talking about FX, absolutely non-farm payroll, that is 100% what's going on. If you're talking about crypto, you need to have Elon Musk on Twitter. It's a must. You have to have him on Twitter. It used to be Donald Trump, and now Donald Trump is suing Facebook, Instagram, Twitter, and his friend is coming out with his own social media. So you have to be just in the market and keep an eye on what's going on.
Perfect. I think that's a great summary, Henry. Thanks so much. Appreciate it for the 15-minute intensive. I know it's a tough one to consolidate all the experience to craft. We start having the first questions actually. So one from Emily. If it is a good time to sell, do you typically sell all your shares in that stock or only some? Does that link back to the 1% of your capital per trade rule?
Okay, so without actually sitting down with you, I can't answer that question properly. But again, so the idea is that you need to see probability in what happens in the market. So the market is very, very predictable. Okay, now if you look back over the last 25 years, we get a Santa rally about 2 weeks before Christmas, and there was 1 year that it didn't happen, and that was in 2008. Okay, sorry, 2018. So that was the 1 year out of 25 years it didn't happen. If you go back over the last 15 years, once we have the summer over, because traders generally go away for summer holidays, their kids, stuff like that there, to go off, take 2 or 3 weeks off. And once they come back, then traders generally rebalance the books. And then we generally have an upward trend from, say, August up to, say, end of January, beginning of February. And why the end of January, beginning of February? Because the last earnings quarter comes out about the 15th of January. And then you have all the hedge funds, people recalibrating their books and closing or taking profit for the end of the year. So that's when I generally hit my take profit if I'm looking to close stocks. If they're growth stocks, that's when I'm looking for to do that. But if you are a valued investor and you have a stock that's undervalued, and then you have the intrinsic value is here, you close it when it hits the intrinsic value. So it depends on you.
Great answer. Thanks, Henry, for that one. Another from Brian. How often should active investor track RSI or stochastic oscillator as buy-sell signals? And how do you feel about Ray Dalio's all-weather approach for long-term investments?
I have no idea what his strategy for long-term investments is. Now, when should we use the RSI and buy and sell? Absolutely never. Absolutely never. It's the problem with using RSI over bought and over sold is that you can look at, say, what's ever happening is Microsoft. Now, I'm pretty sure if you look at the RSI, Microsoft was in a sideways momentum and then it took off. Okay, it was the second $1 trillion company, and if you look at it, it hit the top of the RSI, hit the top of the RSI, hit the top, and just continued hitting the top of the RSI. So if you'd have sold that, now, when I say sold it, I mean take profit out of the stock. Or if you're someone who trades both ways, if you sell it at that particular point, then you would have lost money. So if you're using RSI stochastics, you need sort of Bollinger Bands. and trying to incorporate Bollinger Bands and stochastic. And if you're looking at stochastic, I always change my stochastic to 90-10 because the 80-20 is not a big enough extreme. So I would always change that to 90-10.
Well, thanks, Henrik. Another one coming up here. How does one start trading, learn trading? What are the best books on trading, for example?
Where does one learn how to start trading? There. That's literally, it's the other hand right there. So if you want to learn how to trade, I have a free course that should be ready in the next 2 or 3 days. Whether my design guy, he's been telling me it was supposed to be out last Friday and now it's supposed to be out this Friday, but I'm pretty sure it'll be out next Friday. And I have a free course for anyone who wants to jump in. So henry-ward.co.uk and jump in. I have a free chat room, I have a free course, but it depends on what you're trying to do. If you're someone who has a little understanding of trading and you want to read a book to help you trade better, the best book that I've read is The Psychology of Money. Okay, that's the first one, Psychology of Money. It was absolutely brilliant. And then the second book that I've read that was extremely helpful is Trading in the Zone by Mark Douglas. Now, the two of those are psychology books because fundamental trading and technical trading, you can learn that probably in 6 months. The psychology of trading, it'll take you the rest of your life to master that. That is, you're supposed to stop the emotional attachment to money. But remember, we've been mostly attached to money all our lives. So that's the hard one for us.
Yeah, indeed. I just share a link where I put together some of the top 10 books that I like as well. I share also with Henrik. If you have to start from the beginning, Henrik, it's like you're white, you need to start again. Of course, I've been chasing you, and you're right. Actually, there's so much information out there. There is so many webinars, everything. And I think it's like having somebody who has experience, a very clear path, and take it with your hands. I think it's the best way. Of course, you can do it by yourself, but you get overloaded. So I think that's, I agree with you, like having a mentor to guide you through the process. I think it's a good one. Henry, we have the last 8 minutes.
But trading doesn't have to cost a lot. I remember working for the first trading firm that I ever worked for, and they used to charge people $2.5 grand for the first introduction course. Then they used to charge you $5 grand for a 3-day course, and you got maybe 5 mentoring sessions. And then their top one, well, it was your top one at the time. Then they charge you 20 grand GBP for a year's trading, and they would give you an account. And then it turned into, then they would charge you 36,000 and you could have 2 years trading and you would have a trading account with it. But the problem with that is that you are putting too much pressure on people financially, 1, and 2, time-wise, because that's the biggest reason people don't make money from trading is because of time. And I don't mean time as in they don't have long enough, it's because they give up. They give up. So with the psychology of money, one of the big things that came out, and it sort of resonated with me now, these are all statistics that came from the book, and they're talking about the US stock market. So if you're a day trader, so when I say a day trader, you hold on to a stock or a trade for 24 hours, you have a 50-50 chance of winning a trade. Okay. If you hold on to a stock or a trade for a year, you have a 62% chance of winning this trade. If you hold on to a stock for 10 years, now remember, this is all based on the likes of the US market, you have an 82% chance of making money and winning this trade. And then if you hold on to it for 20 years, on average, you have a 97% chance of making money if you hold on to it for 20 years. And that it literally comes down to what type of trader you are.
Yeah, perfect. I think people are asking again to repeat the name of the books, Henry, quickly.
So the Psychology of Money. So Psychology of Money, that's my top one. We have on our chat room, we actually have a library there where people post books that they've read and stuff. So for me, it's Psychology of Money. And then the second one then is Trading in the Zone by Mark Douglas.
Perfect.
So they're the two books for me by far. Just jumped off the shelf for me. Now I got the audio book, but some of them do the likes of patterns, they do the likes of tests, stuff like that there. So the hardback is good, but even if you're someone who doesn't read and it just hates reading, an audiobook will massively help with the likes of that. So there's some great stories in them.
Yeah, agreed. Also, the great stories as well is the market research as well. I think it's a lot of top stories of top traders. That's the one I'm listening right now, as you mentioned, audiobook. I think it's interesting. Henrik, so I know there's sometimes a lot of platform there, and they want to treat you like, what are the tools there that as a trader you need to start considering? You know, like a free account, can I access a free account to practice my strategies that we discussed today? How would you go around that?
Well, see, I'm not a big advocate for trading on a virtual account. Now, for me, a virtual account, you should be trading on a virtual account for a week, maybe 2, a month maximum, just to understand how to press the buy button, the sell button, understand how to actually place a trade, the very basics. But I'm never one to advocate for trading on the likes of a virtual account, because the problem with trading on a virtual account is you never take it seriously. Now people go, oh, Henry, I'm trading it like it's my real money. Well, you have no emotional attachment to it. So however much you think you're doing the best that you can with the likes of that, you're not. And unfortunately, that's just the way it is. So for me, it's set up either, I know we have NAGA, I trade with them. We also have the likes of eToro. I worked with them. I also trade with them. So they're two of the brokers that I use. And I've never had a problem with any of them, but there's loads of places that you can do it. But make sure you're not going to a broker that's going to give you an introductory offer. So generally, if a broker goes, oh, if you put money in with us, we will give you an introductory offer of giving you an extra 500 quid. Absolutely stay away from them. They're not regulated by the FCA. They're not regulated. They're in Cyprus, stuff like that there. So make sure that you are following and sticking to people that are properly regulated and trade with your own money. So I would say to people, I only ever risk 1% of my account. Now, I know with one of the brokers I use is 50 quid is the minimum you can trade on a stock. Now, if you're trading a CFD, you can go down and trade as little as 7 to 10 quid on a CFD. So it depends on what you're trading with. So you don't have to have huge amounts of money. Now, obviously, the ideal amount of money to start off with is 5K, which means then if you're using that broker, the minimum trade size is 50 quid. So that means then you're using your 1%. But the idea then is that the other 99% is there in case the market drops, because remember, I always leave about 30 to 40% of my capital there as liquid cash. And if I was going to show my platform. So if you look at the bottom of the pandemic, I know, Mario, you were there and we were listening to my stuff at the time. I went shopping, absolutely went shopping. I had a sale on. We had the likes of Apple, Google, Amazon, Microsoft. They all had a 30% flash sale. And it was brilliant, absolutely. And if there's not one stock that I bought back then that is not up 70 to 100%, even some of them are up more. I bought Tesla, and I think Tesla's up 350% since that pandemic. And I know Tesla's come down a little bit, but up at the high, Tesla was up nearly 700% from the retracement in the pandemic. So there's loads of money to be made. There's loads of room for trading. Just make sure you're doing it correctly. You buy when people are fearful. You sell when people are greedy. And that's words of the great Warren Buffett.
Perfect. And I think with that comments, we have 1 minute left. I'll grab one of the questions. What is the best time frame to conduct your analysis when stock trading?
Well, I always do all my analysis on a daily chart. And what I will do is I will just zoom out and have a look at maybe a week. So I'll have a week's chart. And then if I want to see what's going on with the bigger picture, I will zoom out and look at, say, a month or a year or 2 years, or as a stock trader, I will even zoom out as far as the chart will go. I look at 10 years on the daily chart and see, okay, so this is overall going up, the momentum's going up, and what I will do is wait for a pullback. So anyone who's a trader at the moment, we have a pullback on, say, the NASDAQ. Now, we've had one red day on the NASDAQ at the moment. So the NASDAQ is the tech industry in the US, so the top 100 tech companies. And I see on my chat room going, oh, it's red, there's a huge red bar. And if you looked at my webinar that I did last night, I would have said to everyone, I need that red bar to come back. And I need a second, I need a third, and I need it to come back to a horizontal level. And once it hits that floor, that's where I start buying up there. And that's where I start coming in. That's where I start doing that.
Henrik, was an honor based on the last poll result. 9 out of 10 people learned something today. They would love to hear more from you, 100% of the people. So thanks so much, Henry, for the time and for the knowledge. Again, everybody, was our first webinar. So please share your feedback, comments, so we can improve for the next one. Bye, everybody. Have a good time. Thanks, Harry.
If you want to say hello to me, I'm on Instagram, Facebook, to everywhere. I'm everywhere. So henryward.trading is my Instagram. So if you want to reach out, jump in on that as well.
Cheers, Henry. Bye-bye, everybody. Thanks so much for joining.
Bye-bye.